Hello everyone, welcome to another edition of Generation Y here on solar-powered Crew FM. We have a great show for you today. We're going to be joined by Emily Rapp, who's going to discuss mortgages from Millennials, as well as Janet Yellen appointed the new head of the Federal Reserve and what effect that will have on Millennials. Again, this is solar-powered Crew FM, Generation Y, here from Fairfield, and we will be right back with Emily Rapp.
Hi, I'm John Green, author of The Fault in Our Stars, and you're listening to Generation Y on solar-powered Crew FM.
Welcome back, everyone, to Solar-Powered Crew FM. This is your host, Andrew Tint, here on Generation Y, and we are joined for the show with Emily Rapp, whose job title is Finance Services Research Assistant at American Enterprise. And you recently wrote a great article I found fascinating in the usnews.com, an opinion piece on millennials. So I want to start off by talking a little bit about that, and then moving over to talk a little bit about what millennials should expect from Janet Yellen, who was recently elected as the head of the Federal Reserve. Is that okay with you?
Yeah, Andrew, thank you so much for having me on the show.
Oh, it's my pleasure. I've never been this excited. It feels like Christmas morning. I got to ask you right away, can you just explain exactly what American Enterprise is, where you work?
Sure, yeah. The American Enterprise Institute is a conservative think tank located in Washington, D.C. that comments on several different areas of policy issues that are impacting the country to date. I work in the Financial Services Policy Division, so my focus is primarily researching housing finance, particularly housing mortgage insurance and the policies that are impacting low and moderate income families.
So for all those people who say that Crew FM has a liberal agenda, nay, is what I say to you. So let's get right to it. You wrote a great article about the housing market, and one of the things you brought up is the question of, do we believe that today millennials are being smart consumers or not?
Sure. I think the really important thing to take note of here is that unlike many other generations, millennials are coming right out of the gate with a significant amount of debt as related to the debt that they incurred as students coming out of undergraduate programs. So the Project on Student Debt released a study saying that the average amount of student loan debt for the class of 2011 was $26,600. That is a significant amount of debt to be starting out with right out of the gate before earning any type of income. And as it stands today, the average millennial upon graduation, I think this is for 2013 grads, is making about $45,000 a year. And that's an average, so there is a significant part of that population that is making less than that. So if you're saying already that you're already starting out with a significant amount of debt that is almost more than half of your yearly income, it's a tough situation to be as you move forward out into the job force and as you project out and look ahead to a future home purchase.
Well, I couldn't agree more. And one of the issues you and I kind of talked about is, and I'm going to ask you this more as a form of a question, but do you think real estate agents and mortgage companies are kind of weary towards selling to millennials because they know that they have this debt that, unlike housing debt, unlike credit card debt, will not be forgiven?
Right. I think that they're legally, again, they can't actually ask the borrower's age. A broker can't say to a prospective home buyer, hey, how old are you? But what is kind of an impediment to purchasing a home at this point for a millennial is that their FICO scores, their credit scores may be fairly low. Their availability for a down payment right now is probably going to be fairly low at this point, and that can worry realtors, that can worry mortgage originators, but more often than not, they may find alternatives such as encouraging a borrower to purchase mortgage insurance, which is kind of the area of research that I focus on, because this mortgage insurance will enable mortgage originators to give out loans to people who have low FICO scores, who have high debt-to-income ratios, meaning that their rent or mortgage payment is a significant portion of their monthly take-home. And so that's where we really see borrowers get into trouble is when they're not set up to succeed with mortgage payments, i.e. they have a very low down payment that they're able to put out in front at the home purchase, and then their payments can be fairly significant as compared to their monthly take-home. And that's where we see borrowers kind of wavering and not being able to make payments and possibly ending up in foreclosure. So I think, especially post-housing crash, and especially with all the regulatory rules that are taking into effect as a result of the Dodd-Frank Act, I think people are wary to give out loans at this point that may not be able to be repaid. But those loans are still being made. Those loans are still being backed by government organizations, unfortunately, at this point, which really, if anything, not only puts home buyers at risk, but also puts the taxpayer at risk as well.
It kind of sounds to me a little bit like the student loan debt in the sense that banks don't mind giving out this loan, but in this case mortgage insurance, because they know that even if someone defaults, they're going to make the money back. So do you find that perhaps mortgage insurance is actually taking advantage of some millennials because they feel like they need to own a property, but unfortunately they don't realize that they don't have the ability to pay it back?
Right, that's correct. I would say that the greater conversation that needs to be had in this country is how we view home ownership. A lot of House Republicans right now in Congress are saying that the view of home ownership right now in this country is to view it as an entitlement program. But if you really look back and see what it really takes to purchase a home, it's risky to view it as an entitlement program. Addressing your question in regards to mortgage insurance, if you look at who is providing a significant amount of mortgage insurance right now, the Federal Housing Administration is providing a significant market share of housing insurance for low and moderate income families, as well as if you look at the government-sponsored enterprises, Fannie Mae and Freddie Mac are also providing a mortgage guarantee on loans that they purchase and then securitize. So what that's creating, in a sense, is this increased moral hazard, because all of these organizations are promising a 100% guarantee on a loan. So what that means is if you have a bank that's serving as a mortgage originator, should the loan fail, should the borrower go into foreclosure, if the mortgage is backed by one of the GSEs or one of the other organizations, they're going to receive 100% of the money back, right, which means that the bank really has no skin in the game to ensure that a borrower has a substantial amount of credit. So right now, looking at, this is a lesson that has been learned post-financial crisis, and the Dodd-Frank Act actually stipulated a new rule that was supposed to be written by 6 regulatory agencies that is in its second draft form at this point. And my scholars here at the American Enterprise Institute have actually come up with a comment on the second proposed rule, because unfortunately at this point a lot of housing lobbies, a lot of industry insiders who benefit from that greater credit expansion, that allows other borrowers who might not have strong credit, may have lower down payments, they still receive money because of this 100% guarantee. And so the rules as they've been originally written by Dodd-Frank have kind of been chipped away in the sense that they're not creating strong mortgage products. They've actually lowered the requirement as to how much a down payment a borrower must provide in order for that mortgage to then be securitized in the private marketplace. That, again, just dumbs down the rule, encourages crony capitalism, and enables people who are not really concerned about the borrower but are concerned with their own profits. And then we're just going to set ourselves up for another asset bubble and potentially another crash. So that's kind of, I would say, the political environment that we're facing today in housing finance, is trying to navigate this new set of rules. And I think banks are kind of stuck in this strange purgatory, and that there are rules on the horizon that are going to limit who they can and cannot give out loans to. You're hearing a lot in the press now about the fact that people can't get credit right now. But if you look at how credit was expanded in the early aughts, there were borrowers who were receiving credit availability that never would have been able to before under traditional mortgage standards because their credit score was not sufficient or their down payment was not sufficient.
Can you just explain to listeners who might not know what the Dodd-Frank Act is and what it was supposed to do, and maybe what it's now doing, because things never work as they're exactly supposed to?
Of course, yeah. The Dodd-Frank Act was a piece of legislation passed post-financial crisis that was supposed to kind of prevent a crisis of that magnitude from